And here we are back at Europe's new political economy with the last podcast of our first year in this business. Today we have a very special episode for you, and it's also an extra long one, so I'm going to try and keep the introduction short. Alright, this time we're coming to you all the way from California, where Aidan sat down to talk with Gabriel Zucman. Zucman is a professor of economics at Berkeley and one of the world's leading experts in tax evasion and tax havens. His first book, The Hidden Wealth of Nations, was published in 2015 with a foreword written by Thomas Piketty, his PhD supervisor, who you're probably familiar with at this point. His latest book just came out, and it's called The Triumph of Tax Injustice: How the Rich Dodge Taxes and How to Make Them Pay. It's co-written with his fellow Berkeley professor and French economist Emmanuel Saez. You may have heard of Zucman even if you haven't read his academic work. That's because he's one of those economists who has also become a public intellectual of sorts. So, in my case, I first came across him in a column he had written for the New York Times. But you may have also heard of Zucman and Saez indirectly, because of new proposals fielded by some American presidential candidates in the left wing of the Democratic Party, such as Elizabeth Warren and Bernie Sanders, whom they have advised on how to implement a wealth tax in the US. In the following conversation, Zucman and Regan talk about how to translate academic research into compelling arguments in public debate, tax justice in the US and European Union, and how the dynamics of and politics of tax competition play in tax havens such as Ireland.
Well, Gabriel, thank you for joining us here today to talk about your research. It's a pleasure to meet you.
Thanks for having me.
I've read all of your books and your articles, and it's highly influential and has really shaped a lot of my own thinking on these questions. So, I mean, you are, I think, at this stage, one of the world's leading experts on corporate tax avoidance, tax evasion. And of course, your most recent book, The Triumph of Tax Injustice, has made big headways here in the United States of America. We're in Berkeley, we should add to our listeners. So you might just give us a bit of personal background. How did you get interested in these questions?
I think I was profoundly influenced by the financial crisis of 2008, 2009. I was 21 at the time, and I wanted to understand, what's going on in the world. I started looking into macroeconomic statistics, from the Bank for International Settlements or the IMF, the OECD. And in this data, I noticed you see, as soon as you start looking into this data, you see hundreds of billions of dollars flowing in and out of places like the Cayman Islands, like Bermuda, like Singapore, like Ireland. So a ton of money flowing in and out of tax havens. And I thought, wow, that's interesting. There are people in NGOs who are talking about that. People in political science, but in economics, there's not much research in that area. And of course, lots of journalists and investigations, newspapers. So I knew it was a reality. But when I saw the data, it made quite an impression on me, and I thought, okay, let's try to understand the story behind this. What is legal, what is illegal behind these big flows of money in tax havens? Is this all a contributor to financial instability? Is that part of the story behind the financial crisis? And also, what are the implications for inequality? Because in the social sciences, the way that we study inequality is by looking at tax data and survey data. So self-reported information about income and wealth. And of course, a major concern is tax evasion. So we're missing some of the story. And I wanted to have a sense of what exactly are we missing? And is it the case that maybe inequality has increased significantly more than what the official data suggests? And so this was the starting point. That's when I started doing research in that area of offshore wealth, the interplay with inequality, taking a global perspective to study wealth, and in particular top-end wealth concentration, international capital flows in general, and the role of tax factors in those flows. And so I did my PhD at the Paris School of Economics from 2009 to 2013, very much on these issues. Right at the end of my PhD dissertation, I wrote a short book, The Hidden Wealth of Nations, that was published in France in 2013 and then in English in 2015, that summarizes what I found in my PhD dissertation. 8% of household financial wealth in tax havens, most of it reflecting tax evasion, and who loses, who benefits from that. And after that, I moved to Berkeley for a postdoc. I was a professor at the London School of Economics for 1 year. I moved back to LSE as a professor, and ever since then, I've continued working in that area. The interplay between wealth accumulation, wealth distribution, and taxation, the role of tax systems in driving income and wealth inequality, and the role of tax avoidance and tax evasion.
Oh, that's really interesting. We might talk then about the kind of the distributional question shortly, but I mean, it's interesting that I think you probably did something which is, I think, very important in the social sciences. You identified a problem or a puzzle, but that's not easily empirically observable. And then the question for a social scientist is, well, we know that this is a problem and a puzzle, basically tax evasion, the hidden wealth that exists. How do we go about observing this or gathering data on it? So how did you begin to identify and make these calculations? Because you're creating new data and therefore making a big contribution to the public debate on these questions.
Yeah, absolutely. Yes, I think that summarizes well the approach in my research, which is trying to start from the questions, some of the big questions out there. We know very little. It's very hard to measure tax evasion. It's hard to measure income and wealth inequality. It's hard to quantify the magnitude of profit shifting and how tax competition redistributes income across countries and tax bases. But starting from the question and then using whatever data is there in a systematic way, in a conceptually consistent way, to try to come up with some answers, which by definition are imperfect and preliminary and to be improved, but can try to be able to say something on which future research can build and can be improved gradually over time. So one example is the work I did in my PhD dissertation on hidden wealth. So I was interested in that question. Okay, how much wealth is there in tax havens globally? And I started looking for data, and at some point I found very interesting data from the Swiss Central Bank. It's public data about the amount of wealth that Swiss banks manage on behalf of foreigners, of foreign residents. It turns out that this is published every month by the Swiss Central Bank since the beginning of the 21st century. This data had not been used in research before. Oddly enough, nobody had looked really into this. And it's very interesting because you look at that and you immediately see, okay, there's 2.5 trillion in wealth in Switzerland belonging to foreign households. And so that's, one tax haven. That's one starting point. It was interesting. You also see the types of investments that people make through these Swiss accounts. So typically, the typical pattern for a very long time, that's still the case to some extent today, although the origin of wealth is changing. But the typical pattern was you would have a wealthy French or German household who would open a bank account in Switzerland. And of course, the money, when it is in Switzerland, it's not dormant, it's invested. And it's typically invested in mutual funds, in investment funds, many of which are in Luxembourg, in Ireland, and in other offshore financial centers like the Cayman Islands. And so you see this typical pattern: France, let's say, Switzerland, Luxembourg. And then I thought, okay, can we see a trace of these flows, in macroeconomic statistics? And yes, you can see a trace of that in global macro data, in the sense that if you look if you look at who owns the mutual funds that are incorporated in Luxembourg, in Ireland, and in places like the Cayman Islands, you see that a lot of these mutual funds cannot be traced to any known owner, and that's because they are owned through offshore bank accounts. So for instance, if a French person has Luxembourg mutual fund shares through a Swiss bank account, neither France nor Switzerland records any assets, but Luxembourg, is going to record a liability. And so you have a discrepancy like that at the global level between assets and liabilities that reflects the way that this offshore wealth industry operates. And so using these patterns and anomalies in global investment data, I was able to estimate that about 8% of household financial wealth is held in tax havens globally, of which about 1/3 in Switzerland and 2/3 in the other offshore financial centers, like increasingly Singapore, Hong Kong, some extent Luxembourg, Jersey, the Channel Islands, Caribbean islands, and so on.
So I think it's a very good case of the mobility and the international dimension of capital, and capital moving to places that can be stored, and the legal definitions of storing that capital, and of course, which moves on to, it doesn't surprise me that you ended up looking at the extent to which this capital income is taxable or not in the long run. So you started looking at tax evasion and the kind of store of wealth and the store of capital, and how different offshore financial centers operate in this sense. But then you moved on to start to look at multinationals and corporate income and profit shifting in particular, which of course is a central part of the story of the Irish growth model. So how did you shift on to looking at multinational profit shifting?
I mean, generally speaking, what I'm interested in my research is to better understand the redistributive consequences of globalization. So who wins and loses from globalization in its current form, which countries and social groups derive benefits from tax competition, for instance, and which countries and social groups actually lose income because of that. Same thing for offshore wealth. So this is the general theme. And let me stress at the outset that the current form of globalization that exists today is only one among many possible forms of globalization. Right now, we have a form of globalization that's characterized by very little tax coordination or tax harmonization. For instance, countries sign free trade agreements, but in these agreements, there's nothing about taxation. So these agreements go to great lengths to guarantee the property rights of foreign investors, but there's no discussion about the duties of foreign investors. How much taxes are they going to pay, and how are we going to make sure that they pay what they should pay in taxes? So what I want to understand is, okay, this current form of globalization characterized by tax competition, how does it redistribute income? And so what I did in my work on the missing profits of nations with my colleagues Thomas Torslov and Ludwig Veer is we asked a very simple question, which is, imagine that we had another form of globalization. Imagine that all countries had the same effective corporate income tax rate. We have an agreement. All countries agree that they're going to tax corporate profits at exactly the same rate. In such a world, how would the geography of profits, or where profits are booked, would change? So how much more profits would you see in Germany, in the US, in France, as compared to today? And by how much profits would fall in countries like Luxembourg or Ireland or in today's tax havens? And the answer we obtained is the world would be quite different, in the sense that tax competition does redistribute a lot of profits internationally. So one number we have is, if you look at multinational profits, that is the profits made by firms outside of the country where they are headquartered, like the profits made by Apple outside of the US. If you take some of this for all multinationals, what we find is that 40% of that total amount of multinational profits are shifted to tax havens today. That's more than $650 billion in recent years, of which about 100 billion is shifted in Ireland, which according to our statistics is the number one tax haven when it comes to corporate profit shifting. But a lot of profits also shifted to places like the Netherlands, like Luxembourg, like Cayman Islands, Bermuda, Singapore, and other offshore financial centers. So the quantitative implications of that profit shifting are significant. When you look at, for instance, one thing that I discovered doing this research, and which in fact is quite intuitive when you think about it, but it's quite striking, is when you rank countries by how much corporate tax revenue they collect as a fraction of their national income, you see that the countries that collect the most corporate tax revenue are not the countries with the highest tax rates, or the countries with the lowest tax rates. The country with the highest ratio of corporate tax revenue to national income is Malta. And then, Cyprus, Hong Kong, Ireland, small countries that apply low tax rates to a huge base of profits that they attract from the rest of the world, generate much more tax revenue relative to the size of their economy than countries like Germany or France or the US. So that's one illustration of how tax competition redistributes tax revenue and income across countries.
So it might be of interest to you that in that particular paper, I think the total amount of revenue coming from the corporate tax sector as a percentage of total revenue in Ireland was between 5 and 8%. That has since increased to about 20%, which means 1 in 5 euros that is spent by the Irish government effectively comes from this particular sector.
Yeah, that's incredible. And it illustrates, the problem, which is that we can debate about what's the proper rate of taxation and whether low corporate tax rates are good for growth and for investment. And that's fine. And it's normal to have a debate about that. It's also fine for countries to choose their own tax policy, and we should respect that. At the same time, when the tax policy of some countries like Ireland have large externalities on the rest of the world and on other European Union countries, there is a problem. There's something which is not sustainable, because what this means is the end consequences of all of that. What really matters is not that the income is or tax revenues are being redistributed across countries. What really matters is that at the end of the day, multinational companies and their shareholders pay less and less in taxes. And so you are in a situation where the very winners from globalization end up paying less and less in taxes, while at the same time, those who don't benefit a lot from globalization in its current form or even suffer from it, retirees or small businesses or low-wage workers, are paying more and more. They are paying more in consumption taxes, VAT, or in labor, payroll taxes. And so if globalization means this, lower taxes for its main winners, higher taxes for those who don't benefit from it, you can immediately see that it's not sustainable, neither economically nor politically. And that's the problem. Down that path of tax competition, profit shifting, no international coordination, there is no clear future for globalization. So we need to think about other ways, other forms of globalization that are going to be more sustainable.
I think that's an important point, because often in Ireland, there's an assumption that this is tax competition. Tax competition is good for Ireland. It generates economic growth, creates high income jobs. ensures a certain graduate level of employment, and therefore in total aggregate social welfare, and Ireland benefits. And therefore Ireland is a success story of globalization. But what you're getting at, I think, is very important, which is that actually by doing this type of activity at a more global level, you undermine globalization. Because those who are not directly benefiting from it, if there's a beggar thy neighbor approach effectively by different nation states, it makes it very difficult to ensure that you solve those collective action problems that ensure the ability of this to be sustainable. So on the coordination question, is the OECD BEPS proposals enough?
Yes, that's really important. So I think I understand, and it is true that some countries can derive some benefits from tax competition in the short or in the medium run, but in the long run, it doesn't strike me as very sustainable. And at least, what's clear is that there is another form of globalization that's possible, where instead of having a race to the bottom in corporate income tax rates, you can have a race to the top. So imagine, for instance, that all countries have the same corporate tax rate, to simplify, or that all countries policed their own multinationals to collect more taxes, let's say in Germany or in France, if those firms shift profits in Ireland or in Bermuda. So imagine that taxes now are out of the equation when companies choose where to operate. There would still be some international competition, but it would be another form of international competition. It would not be based on cutting taxes. It would be countries would compete by providing the best infrastructure, by having the most highly skilled workforce, so having the best schools, best universities, by having deep markets where consumers have a lot of purchasing power. And so you could have a globalization and a form of international competition that would be characterized by this type of race to the top, more investment in higher education, and so on and so on. To move to this alternative form of globalization, you need to address tax competition. The question is it the case that the OECD process, the BEPS process is doing that? At that stage, not really, because most of what the OECD has been doing so far, everything that it has done so far has been about the definition of the tax base. So how should we compute the profits made in Ireland, made in Germany, made in the US? But there's been no discussion up until very recently about tax rates. And so you see the problem. Even if we had a perfect definition of the tax base, but at the end of the day, if the tax rate that's applied to that tax base is 12.5%, or 6.25%, like in the case of patent boxes in Ireland, or tomorrow 1 or 2%, it's a big waste of time. You can spend decades agreeing on the definition of the tax base, but at the end of the day, what matters is how much revenue and what's the effective tax rate. So what we need is a much more ambitious form of international coordination, not only on the definition of the tax base, but on tax rates. There is some progress in that direction today with BEPS 2.0, and in particular Pillar 2 in BEPS 2.0, which is about an agreement on a minimum taxation. But at that stage, it's still very limited, and this process is still in its infancy. What's being discussed in terms of minimum tax rate or tax rates around 10%, maybe 12.5%. That's not going to fix anything. Ireland has the lowest tax rate in the EU with a 12.5% corporate tax rate. So if the minimum tax rate is the lowest tax rate, nothing really changes. And so, but at the same time, it's a step in the right direction, because now finally there is some discussion about tax rate coordination, but much more needs to be done, and we need to move towards much more ambitious forms of minimum taxation with rates of 20-25% at least.
But I think the very fact that the OECD are today even talking about having a global effective rate suggests that the debate has moved on quite a bit compared to, say, a few years ago. And from BEPS 1, we know that actually that is one of the reasons why Ireland's total corporate income tax rate as percentage of revenue has gone up so much, because many multinationals are trying to move ahead of the changes that they anticipate by shifting a lot of their assets, their intangible assets, their brands, etc., their capital structures into countries like Ireland that are not tax havens in the very secretive way of the Bermuda Islands, but ultimately they are, because it's allowing effectively capital to reduce and avoid taxes. So in that sense, Ireland is a net beneficiary of BEPS 1, but I think BEPS 2 is a response to the fact that actually this is taking place at this point in time.
Yeah, and I agree with you that my feeling is that things are actually moving in the right direction, and we may be as a community, as a world, at a turning point. I remember just 1 or 2 years ago, if you would ask experts at the OECD, IMF, tax experts, lawyers, what do you think is the future of the corporate tax? What do you think is the future of tax competition? Almost all of them would say, look, there will always be some countries that will offer lower rates than their neighbors. Tax competition can only intensify in a more and more globalized world. The race to the bottom is going to continue. It's a natural thing. It's like a law of nature. There's nothing you can do. That's the only possible future. And I think today, more and more people realize that, wait a minute, that's just not true. That's a choice that we are making collectively to tolerate tax competition, to tolerate profit shifting. But there are lots of other possible choices. And I think it's likely that we are going to see in the future, I don't know if it's going to be in 2 years or in 5 years, but we'll see countries increasing their corporate tax rate. And perhaps the US, if Trump loses, the next presidential election, if a Democrat enters the White House, it's very likely that the US will significantly raise its corporate income tax rate. That would be a dramatic change in the trend that's been observed since the 1980s. We're seeing the UK, for instance, for a very long time, the official position was we want to have the lowest rate among G7 countries, and we are aiming for 17%, even perhaps 15%. Now this is already changing. We're hearing less of that. So my feeling, in contrast to what most of the experts have been believing for a long time, is there's a growing recognition that the current trend is not sustainable. There are more and more concrete proposals on the table to address profit shifting and tax competition, and we are going to see an increase in corporate taxation, corporate profits taxation, in, I think, the relatively near future.
And it's interesting, in the European Union, a large part of the story and justifying narrative, particularly by the competition commissioner, is not so much on the question of distribution, fairness and equality, which we'll talk about shortly, but that this undermines market competition, that actually giving certain companies unfair privileges, let's say, gives them unfair advantage in the market. So in that sense, the kind of European ordo-liberal tradition, which is using the levers of the state to ensure a more level playing field for business and capital to compete with each other, may end up being used as a tool to try to avoid and ensure some greater level of tax coordination on these questions.
Mm-hmm. Yeah, absolutely. And look, it's important, but at the same time, it's a very direct way to address the problem. It's true that profit shifting, multinational tax avoidance creates a competition problem. Some firms benefit from tax rulings, from special deals. They get lower effective tax rates than domestic businesses. And that's a bad thing. It distorts markets. It distorts competition. And it's good for the EU to go after that. At the same time, there would still be a problem if all firms, whether big or small, paid 2% or 5% in corporate income tax. There would still be a problem that needs to be addressed, even if there's no distortion. So we need to go beyond that approach. It's very important that the EU moves towards some form of common tax policy and some form of tax coordination, because a construction, a union where you have free labor mobility, free capital mobility, and absolutely no coordination, no common policy when it comes to taxation, which is the case in the EU right now because of the unanimity rule when it comes to tax issues, it's not going to work. There's no example of such a thing working. The real risk is that we're going to see more and more of a disconnect between the working class and the middle class and the European Union.
Yeah.
That less and less support for the European construction in its current form. So that's eventually a major risk for the whole EU project.
And there's also a revenue generating component, which we can perhaps come back to in the conclusion. But in the opening of your most recent book, The Triumph of Tax Injustice, How the Rich Dodge Taxes and What to Do About It Effectively, I think it's a great book. I would encourage our listeners to read this book. You open up with a great example of the presidential debate in 2016, where Hillary Clinton confronts Donald Trump about his tax avoiding strategies. And his response was, well, that makes me smart.
Yeah.
Which I think is very interesting, because there is that is the assumption that avoiding taxes makes me smart. And in Ireland, for example, this attitude, although very rarely spoken, also prevails quite strongly, that avoiding taxes is the smart thing to do, because smart legal accountants can make this happen, basically.
Yeah, and to some extent, look, to some extent it's not wrong, except that pushed at the extreme, we understand the paradox and the inconsistency in that logic, which is that behind this theory that avoiding taxes that makes me smart, there is this idea that the pursuit of self-interest, relentless self-interest, is what makes communities prosperous. It's the key engine of economic growth and progress. And look, sometimes, the pursuit of self-interest and narrow self-interest, to some extent, can be a good thing, can be an engine of growth. That's fine. But if everybody only does that, then there's no society anymore. Then at the end of the day, this type of attitude destroys the norms of trust and cooperation, which are at the heart of any prosperous community or society or union of countries. It's the same thing for Trump and for the tax policies of tax havens. If you generalize their behavior, I only care about minimizing my taxes, attracting, winning at the expense of the rest of society, that's not sustainable. The lesson of economic history, I think one of the big lessons is, what makes countries grow fundamentally is the creation, is social trusts, is institutions in which that have a lot of support in the population. It's also mass investment in education, in health, in infrastructure, in all these public goods and services that make people more productive. And to do that types of investments, you need tax revenue, and so you need to fight tax avoidance.
You certainly could not apply the Kantian categorical imperative to tax avoidance, that's for sure. But let's just, in the book itself, there's a couple of incredible takeaway statistics, such as that the richest 400 people in the United States have a lower tax rate than the poorest 50%. That the average income of the bottom 50%, which you refer to as the working class in the book, is about $18,000 to $20,000, where it's over $1.5 million for the top 1%. And then, of course, within the top 1%, you've got the multi-billionaires in the top 0.1 and right up to the top. And I think one of the most interesting takeaways from the book, for our listeners, is not just the point that the 400 richest billionaires in America have a lower tax rate than the poorest in America, but that even if you did have, there's been less tax progressivity. Mm-hmm. There's often an assumption that the tax system is progressive, but actually what we see in the United States, at the very top, it's deeply regressive, which I think resonates with a lot of people, because people may not be hugely motivated in terms of voting for redistribution and the welfare state and so on, but they probably will be motivated to think about the fact that they're paying pretty high taxes and somebody else who's earning multitudes of what they're earning are paying less.
Exactly, yes. So what we call tax injustice is the fact that as their income grew very fast and their wealth exploded, the very wealthiest Americans have seen their tax rates collapse. While at the same time, the working class, whose income has essentially stagnated since 1980, has seen its tax rate increase. And that's tax injustice. And to the extent such that in 2018, which is the first year after the Trump tax reform of 2017, when you compute the effective tax rate of each group of the population, from minimum wage workers to billionaires, taking into account all taxes at all levels of government. So not only the individual income tax, but also corporate taxes and sales taxes and payroll taxes, everything. What you see is that on average, Americans pay about 28% of their income in taxes. The working class pays only a tiny bit less than that, around 25-26% of their income in taxes. The middle class, about 28%. The upper middle class, a tiny bit more than 28%, maybe 29-30%. There is a very mild progressivity. But then at the very top of the distribution, the tax system, the US tax system becomes regressive, with billionaires having an effective tax rate of 23%, which is the lowest in the entire population. So many people have this view that the US, the US may not collect a ton of taxes, but at least it does so in a progressive manner. The tax system is progressive. In actual fact, that's not true anymore. The US tax system is like a giant flat tax that becomes regressive at the very top end. The reason for that is essentially the tax reforms of the last 2 to 3 decades have dramatically reduced tax rates on capital. Corporate tax has collapsed. The corporate tax in the US used to generate as much revenue as the individual income tax in the early 1950s, 7-8% of national income. Last year, the corporate tax, the federal corporate tax in the US, collected 1% of national income tax revenue. It's been divided by a factor of 7. It's almost dead, essentially. Same trend for the estate tax, same trend for dividends, who now benefit from reduced rates in the US, capital gains. So all forms of capital taxation have not completely disappeared, but have been dramatically weakened. And at the same time, the taxation of labor has increased quite a lot. This process of rising inequality, declining tax progressivity, is not specific to the US. It's something that you see in many countries. But what's particularly striking, the US is an interesting case study because this process has been particularly strong in the US. Inequality has increased in many countries, but among developed countries, it's in the US that it has increased the most. And tax progressivity has fallen pretty much everywhere because of the decline in capital taxation, but it's in the US probably that it has declined the most, because the US used to have an extremely progressive tax system. In fact, from the 1930s to the late 1970s, it probably had the most progressive tax system in the world, with corporate tax rates of 50%. And not only nominal, but effective corporate tax rates of 50%, with top marginal income tax rates on income of more than 90% in the post-World War II decades, with top estate tax rates of close to 80% from the 1930s to the 1970s. The US went very far in the way of tax progressivity, which corresponds to something that's deeply rooted in American society. The US was born in part in reaction against the highly unequal aristocratic societies of Europe in the 18th century. And from its creation to at least the middle of the 20th century, or 1970, at least the middle of 20th century, people in the US have been very concerned about becoming as unequal as Europe. Europe was seen for a very long time as a kind of anti-model, too unequal, not democratic enough, a kind of oligarchic anti-model. And so there is this tradition of tax progressivity in the US, of using the tax system to regulate inequality, to make sure that the country doesn't become as unequal as Britain or France. And of course, it has changed dramatically. And today, many Americans consider that Europe is too equal, and there's too much progressive taxation in Europe as compared to the US. But anyway, this is just to illustrate, to explain why we in that book we focus, with my co-author Emmanuel says, we focus a lot on the case of the US because it's so striking, and there are lessons to be drawn for Ireland or for European countries, because inequality has probably not increased as much in Ireland, or certainly not in France or in Germany as in the US. But it would be a big mistake to wait for the situation to become as bad as in the US, because now we see kind of what's down that path, in terms of political reaction, in terms of a stagnation of standards of living for the working class. So just one statistic, in the US, for the third year in a row, last year, life expectancy has declined. So in 1980, life expectancy was the same in the US and the rest of the OECD. And today, it's 3 years less in the US than an average in the OECD. Another statistic, you look at the average income, you mentioned that of the working class, the bottom 50% of the income distribution in the US. The average income was $18,000 per adult, adjusted for inflation, in 1980. And today it's $18,500. So first of all, it's not a lot. That's the average income for half of the population. It's very low. And second, it has barely increased over almost 40 years. So you've had half of the population essentially that's been excluded from economic growth.
So why don't the American electorate vote for more redistribution?
That's a good question. That's an important question, and there are several potential answers to that question. But the thing I want to stress is when you ask voters whether they believe that the rich pay enough in taxes, or whether they believe that multinational companies pay enough in taxes, overwhelmingly they say no. If you ask them, for instance, do you support a tax on wealth, a 2% wealth tax above $50 million, which is a tax that's been proposed by Elizabeth Warren, one of the candidates in the Democratic primary, 70% of Americans say yes, including a majority of Republicans. They say, even before you tell them how the money would be used, on the idea of a wealth tax on the super rich, 2% above $50 million, there's a huge majority of Americans, both Democrats and Republicans, who support this type of ideas. For a very long time, neither the Republican Party nor the Democratic Party were offering a progressive tax platform. The Republican Party has been running on less taxes for the rich for a very long time. The Democrats, the debate was about should the top marginal income tax rate be 35% or 39%, but nothing very ambitious. And they had become convinced for some reason themselves that Americans don't like the idea of taxing the rich, which is not what you see in opinion polls. And so they were not emphasizing that. But we are seeing a change today. If you look at the tax platforms of Elizabeth Warren or Bernie Sanders, or even more moderate candidates, what they're proposing today is much more ambitious than what was proposed by Bill Clinton or Hillary Clinton or Barack Obama. And even if you look at Bernie Sanders and Elizabeth Warren, their tax plans are even more progressive than the Roosevelt era, the New Deal era tax system with its 90% top marginal income tax rate. So what they're offering is they want to create the most progressive tax system the world ever had. So the debate has really changed a lot in just a few years.
And in the book, and I think you make the case rather convincingly, and correct me if I'm wrong, I think you've been influencing Elizabeth Warren's tax plan, right? Her proposals on a wealth tax. You point out that even if you had a progressive income tax system, it still would not fundamentally solve the problem because of the stock of wealth that exists, because this wealth could effectively become, tax-free as well, which is why you need to have a federal wealth tax, which for our listeners is a tax on the total stock of capital wealth that somebody individually owns, which can be ownership of a company, it can be your household, it can be your yacht. Altogether, what's the market value of that and what would be the tax on that? I think that's often not very intuitive to a lot of people. And I think, this website that you've created as part of the book makes it a little bit more intuitive, and the debates that are taking place within the Democratic primaries are also making it slightly more intuitive. Mm-hmm. So it would be a 3% tax on the overall market value of somebody's wealth. That's the proposal.
So the idea, yes, the idea of a wealth tax is to tax the stock of wealth itself, not only income. In the proposal by Elizabeth Warren, it's any dollar above $50 million would be taxed at 2%, and any dollar above $1 billion would be taxed at 6%. And why is it a good idea, a wealth tax? What role would such a tax play? The reason why a wealth tax is a good idea is that it's the proper way to tax billionaires. The income tax is not enough because when you are extremely wealthy, it's very easy to own a ton of wealth while realizing very little income, while having very little taxable income. So let me take one example. We take Warren Buffett. He is one of the main shareholders of Berkshire Hathaway, a big company. He instructs the company not to pay dividends. And so his only taxable income is when he sells a few shares every year of his company. And he realizes a bit of capital gains, typically of the order of $20 million. And he pays taxes on that $20 million in taxable income. But $20 million is just a very, very small fraction of his true economic income. His true economic income, that's his share of Berkshire Hathaway's profits, which is something like several billion dollars, maybe $5 billion. That's his true economic income. Out of that $5 billion, he's only taxed on $20 million. So his effective tax rate as a fraction of his true economic income is essentially 0%. And even if you make the income tax more progressive, it's still going to be 0%. So to properly tax people like Warren Buffett, but the same is true for Jeff Bezos, for Mark Zuckerberg, for Larry Page, most of the top billionaires in America and in every part of the world are in the same situation. They own a ton of wealth, but it's very easy to structure one's wealth when you're very rich so that it generates little taxable income. So for them, you need a wealth tax.
So I think if we're talking about, a new contemporary variant of globalized capitalism that's progressive and working in the interests of, the working middle classes of the world, and if part of that is tax coordination, ensuring you have an effective corporate tax rate and also tackling tax injustice, it seems to me that a wealth tax is a reasonable path to go down because you're talking about the stock of capital that somebody owns, which I think instead of taxing labor income, you're getting at that wealth question. Is something like that feasible in the European Union?
Oh, yes, very much. And I think it should be one essential goal for the European construction in the years ahead, to create something like an EU wealth tax, just like the US is discussing these days the creation of a US federal wealth tax. The European Union could say, we're going to have a federal wealth tax on wealth above, 20 million euros. If you have 20 million or less, you pay 0. If you have, any euro above 20 million, could be taxed at 2%, 3%. And billionaires, the rate could be higher. And this type of tax is in fact not very complicated to implement because most of the wealth of the super rich is listed equities and bonds and mutual fund shares that have a clear market value. about 20-30% of that wealth might be invested in private businesses that are not listed, but it's not very hard to value those businesses based on their profits and the market valuation of comparable businesses. There are not so many people who have more than $20 million, so it's relatively easy to have high audit rates to make sure that they report their wealth well. If you have a wealth tax at the level of the EU as a whole, there's no problem of intra-EU tax competition. You cannot escape the tax by moving to Luxembourg or to Malta. Mm-hmm. So it's doable, and frankly, I think not only is it doable, but if we want to reconcile the European population with the European project and with the European Union, we need to move in that direction. We need some concrete steps that will show how European integration is not only in the interest of the most mobile tax bases and the most highly skilled individuals and the biggest multinational companies, but is also in the interest of the rest of the population, is also able to implement progressive fiscal institutions that will benefit the majority of the EU population.
Okay, well, Gabriel, this has been a fascinating conversation. Thank you, and
thank you so much.
Hopefully we get you over to University College Dublin one day and we can continue this conversation.
Absolutely, yes.
Thank you.
Thanks.
This is really interesting.